Assalamualaikum and hi everyone. As you can see on the screen, our topic today is accounting for non-current asset from chapter 9. Before we start, let me introduce my group members. Husna Fasiha binti Abdul Manas, Nurul Izzati binti Syarif, Zarina binti Zakaria, Nur Erika Shafira binti Ahmad Nordin. Firstly, I will start off by talking about definition of non-current asset. First, the non-current asset has to be consistent through time. We bought the non-current asset not for resale, and also it has to be more than one financial year. We will continue with the characteristics of non-current asset. There are three types of non-current asset. The first one is fixed non-current asset, secondly intangible, and last one is long-term investment. So we go through first the fixed non-current asset. It is touchable, means we can touch it, we can see it, and we can hold it. For example, land, vehicles, and buildings. Next, the intangible non-current asset is it has no physical existence, such as patents, copyrights, and goodwill. And the third one is long-term investment. When dealing with a fixed asset, there are three important events. The first one is purchase, how we calculate cost and how we recorded it. Second one is depreciation, also about calculation and we journalize it. Third one is disposal, means the three events, the important event that we have to make sure that we can calculate it and we can record it. Okay, let's move to discuss about the measure the cost of fixed asset. That means all expenditures necessary to acquire the asset and make it ready for intended use. Okay, this is the flow on how we calculated the fixed cost. We have the cost price from our invoice and then we have to add the cost to prepare the asset for its intended use from transportation charges, installation and testing, sales tax, and also legal fees. Now we continue with the depreciation concept. According to FRS 116, depreciation is defined as the systematic allocation of the depreciable amount of an asset over its useful life. Two main accounts involved in generalizing of fixed asset. Firstly, depreciation concept, which is recorded on the debit side and reported in profit or loss statement as expenses. The second main account is accumulated depreciation expenses, which is contra to fixed asset account, recorded on the credit side and reported in balance sheet under the fixed asset. Okay, now let's proceed with basis in computing depreciation. We have to be more focused because understanding this basis is important in calculating the depreciation after this. We have two bases. There are monthly and yearly basis. In monthly basis, it's quite detailed in calculate the depreciation because it depends on the date in the current purchasing month. If we buy or purchase the fixed asset any date from 1 to 15 in that particular month, we declare is 1 month depreciation. And if we sell the fixed asset from the date 16 until 30 or 31, the full month depreciation also declared in that particular month. So, in yearly basis, it is quite easy because we will declare the depreciation full amount in the purchase year regardless of the date and month. And there is no depreciation declared on the selling year. So, I will start with the straight line method. It's about how we allocate an equal amount of depreciation to each year. So, we will use this formula. Yearly basis, we will have cost minus residual value over useful life. Or we can also use the second formula, that is percentage of depreciation times cost minus residual value. So we will continue with the second method, which is reducing balance method. Reducing balance method charge depreciation at a higher amount in the earlier years of an asset. The amount of depreciation reduces as the life of the asset progresses. So now let us look to the formula for reducing balance method. Depreciation per annum equal to net book value times percentage rate of depreciation given. Okay, now we move to disposal of fixed asset. There are three steps of disposal. Firstly, remove the old disposed. We have the credit machine. Secondly, associated accumulated depreciation from the books. Debit account depreciation. And lastly, determine the amount of gain or loss. Debit loss on disposal or credit gain on disposal. Now we move to selling fixed assets before end of use life. The formula is gain or loss equal to cash received minus book value. If book value more than cash received, it means loss. If book value less than cash received, it means gain. When we want to prepare journal entry, the first one we have to remove fixed asset. That means credit fixed asset. Number two, we remove the accumulated depreciation. So we have debit accumulated depreciation. Number three, receive cash. We have to debit cash, cost increase. Number four, we have to calculate gain or loss or missing figure. So we look at the missing figure either in the credit side or debit side. So if the missing figure in the credit side, so that is gain on disposal. And other one, if the missing figure in the debit side, so that is loss on disposal. So we move to exchange fixed asset for another fixed asset. The formula is gain or loss equal to trade-in value minus book value. If book value more than trade-in value, it means loss. If book value less than trade-in value, it means gain. So we look to the example of journal entry. Debit machine, accumulated depreciation, loss on disposal, and we should credit machine and cash. So the explanation is to record the exchange old machine for new machine. So another one, debit machine, accumulated depreciation, credit machine, credit cash, and credit gain on sale of machine. The explanation is to record the exchange old machine for new machine. So that's all from us. Thank you everyone.